Hello, hi, good day everyone. Today we're gonna discuss about next chapter, which is the financing strategy chapter. So in this chapter, what we're gonna learn is about, as far as concerned that in the architecture of the corporate growth, company or most of the enterprise, raising capital is one of the most critical challenges for them that they will face. But capital acquisition is not actually merely a task of requesting fund, not only, but it require a deep understanding of corporate finance, asset valuation, and also risk strategy as well. And today we will explore. In this topic, we will explore how to logically build a financing mix, which is aligned with the long-term strategic objective. Okay, our roadmap for the chapters today is structured exactly around the five learning outcome, important five learning outcome. First and foremost, at the end of this, at the end of this course, students should be able to first and foremost assess your personal financing preferences and risk profile. The second one is compare the fundamental types of the business financing available. The third one is evaluate the structural pro and cons of debt versus equity. And the next one is identify strategic sources of capital for organizational growth. And finally, what you should learn is what you're gonna learn is appraise stock and bond as an institutional investment alternative. Okay, let's begin with our first outcome, which is assessing your financial preferences. And of course, funding choices are driven by your personal risk tolerance because knowing that's your capacity to sustain potential threats of loss, of course. And it's said that you must also look in the mirror and decide. From that, you can decide how much personal exposure you can handle. If let's say if the potential loss of asset keep you awake at night, it is a possibility of high leverage that might be a poor fit for your company. And you have to remember that institutional backers always look for skin in the game, which is they demanding for your own capital and before they risk their investment on your company. And next, moving to our second outcome, which is you compare, alright, the types of business financing available when internal cash in your company itself isn't enough. You have three primary pathway, which is first, you can get a gift and grant, which is a gift and grant non-repayable fund from the family or government stimulus program that preserve your ownership. And the next one, you can also gain debt financing, which is debt financing is a growth fueled by borrowed money. You require structured principal in interest payment. And the next one is you can also get equity financing, which is trading a piece of your corporate kingdom, or you put some amount of money for an immediate cash injection from the outside partners. Okay, and now we move to the pros and cons of the debt financing. So in the in these slides, what we will discuss is about what is the advantages and what is the risk if you have involving in the debt financing. And the primary one is first, of course, the advantages of debt financing itself, you will still have management control, and because the creditor themselves is not your partner. And they of course they hold zero voting power or to influence your boardroom in a company. And furthermore, it also it is a predictability, which is in terms of in terms of predictability, it discusses about monthly payment. When you have the debt financing, you know your monthly payment, and majority of the most of the time the monthly payment is a fixed, and it is predictable. You will know how much will pay, right? And then however, when we discuss about the risk of the debt financing itself, it's quite severe because involving in debt service creates of course create a fixed cash drain, or we can say that a rigid fixed cash drain during the lean cycle themselves, right? If you have default payment, the lenders have the legal authority to collect the loan and to force foreclosure liquidate your business as well. Okay, now we move to the equity financing, which is pros and cons of the equity financing. And seems like debt financing, equity financing also have the own pros and cons that you have to put into your consideration. Which is the most fundamental one is in equity financing there will be no debt service, which is zero debt service. Which no debt service means zero mandatory monthly payment. And return or cash is paid based on the profit again from the equity financing. And next is the another advantages of the equity financing is that there will be risk sharing because each partners investor assume high ultimate risk, and the risk will be shared together among each partner. And another thing is that when we talk about cons or risk of the equity financing is there will be profit dilution and also loss of autonomy, meaning to say that in distinct loss of autonomy, you will surrender which is more than 50% of your voting power. And of course you open the door to corporate takeover when you have default payment, and meaning to say that you could be removed from your own company. That's the that's the cons of the equity financing. Okay, if you choose the debt pathway, of course you must master how institutions score your viability before they put some of money for you to lend. And most of the time lenders assess the risk, the viability through the 5 C's of credit. There are 5, which is the first one is the collateral. What does it mean by collateral? Collateral is the tangible assets you pledge to secure the notes. Another thing is character, which is your historic credit footprint, and looking at the reliability record, the previous history. And the next is capacity, which is they will see your clear operational cash flow available, so that you can comfortably service the debt if they give you some amount of money to lend. And then the next is a capital, which is the level of personal equity wealth you have already committed during or current or previous. That's the thing they will see. And then the last C is a condition, which is the broader microeconomic trend and the current health of your industrial sector. By looking at by looking at your business itself, is it viable, is it feasible or not? That's the most important thing. And by looking also your industrial sector, is it more profitable? You will gain or you will lose in the industry that you are in during the during or before they give you some amount of money to lend. And next is the fourth milestone. The fourth milestone is about identifying a source of a capital. So usually, in identifying source of capital to the venture capitalists. So venture capitalists normally it for high growth and also for scaling venture for big company. And venture capitalists are very high stake professional fund, which is expecting an aggressive for more than a 45 return on investment, which is seeking a 6 to 10 times return over your 5 years runway of the business. And usually for the early stage of the doing the business, we targeted as an angel investor, which is what is angel investor. Angel investor is affluent individual that fund early plans with the personal cash, which is most all the time they will often bringing deep industry network and also mentorship that money sometimes cannot buy. Okay, just now we discussed about venture capitalists, which is fit for the high growth company. So what happen if the company doesn't fit with the high growth venture model? So of course there will be alternative capital for them, and it is important to have the alternative capital to help them to grow. And the alternative or some of the alternative funding channel that the company who doesn't fit with the high growth just now is that one of them is CDFI, which is Community Development Financial Institution, and which is a provide of affordable credit to emerging domestic market and low income area. And another alternative is that vendor financing, vendor financing is they will allow you as a borrower or business or entrepreneur to leverage trade credit line and cash flow float, which is usually effectively using using the supplier terms to fund the inventory. And the last one is the bootstrapping. Bootstrapping is the ultimate operational discipline, growing sustainably through the grids and equity and also organic sales. Regardless of the funding stream that we discussed earlier, your primary weapon is that you have to have a solid business plan. Without a solid business plan, then everything that you have planned, everything, your justification is being nowhere, because they don't know how possible profit that you will gain, that you will get if they give you some amount of money or they lend you some of money. Then you have to understand your audience. When you want to present your idea, you want to present a justification, you have to be professional, which is you do not read your report. You have to confidently elaborate, justify, giving as the best as you can to confidence the lenders or the bankers to give you the borrow you some money, right? And you cannot read the business plan as if you read like a novel, because from that they will evaluate you on the spot when you are in the time that you want to answer the question and whatnot. And usually bankers they will skip directly to the cash flow table. The most part is to test, of course, to test your repayment feasibility. And also venture capitalists, when you involve in venture capitalists, they straight away to the executive summary, which is you sum up everything business that you did in the business plan, on the first part of your business plan, right? In the executive summary, which is to see the scalability of the metric or scalability of the viability of the business itself. And that's why you have to plan clearly, to the market, that you can recover all the principal, or you can pay them on a time through your presentable rate of return. Okay, and now we move to the final objective, which is require us to do or towards the investment alternative. So what the alternative on investment that you can get is that it is appraised on stock and bond. So before you appraise the stock or bond, you have to understand well what does it mean by stock, what does it mean by bond, isn't it? And then the stock is represent fractional equity unit of the corporate ownership, and it's providing a high long-term growth potential through the capital gain. But it's also exposing you to the market volatility, of course. And in terms of bond, it is a long-term debt securities issued by the corporation, issued by the government, offering fixed coupon rates over a set of maturity period. So you can get, you have to know what does it mean by bond first. And appraising those both of these alternative investment allow the company or businessman or entrepreneur to intelligently design company's capital structure, and of course maximize your return on surplus cash as well. So in conclusion, what have been discussed just now is actually successful financing is the art of matching between your capital needs and your personal risk tolerance. If you know how to tolerate both things, you can success in getting the financing from the lenders and borrowers. You can also control the requirement, and it will be a strategic roadmap for your business itself lah. Okay, and of course, by mastering all those 5 key elements just now that have been discussed previously, of course you will turn the financing into the predictable competitive advantage to compete with the competitor. And thank you very much for your time. Till we meet again on the next chapter.